If your paycheck lands in one of these 9 banks, you need to hear this before your next statement drops. I spent 15 years inside the banking industry, watching customers get bled dry by fees that were never clearly explained. This isn't a rumor, it's regulatory record, and I've got the receipts. Stick around because number 1 might shock you, and I promise there are 4 banks that actually deserve your trust. Number 9 is Regions Bank. Behind the friendly branch smiles, Regions built a system of surprise overdraft fees, charging customers even after telling them at checkout that they had enough money to cover a purchase. Internally, this practice is called Authorize Positive, Settle Negative, and it means your balance can look perfectly fine on the app while a fee is already queued up behind the scenes, waiting to hit once the transaction actually clears. I have sat in meetings where this exact timing gap was discussed as a revenue opportunity, not a glitch to fix. Regulators eventually forced Regions to refund over $190 million to the very people it misled, one of the largest overdraft settlements in banking history. That's not a mistake. That's a business model built on exploiting timing, and it took a federal order to unwind it. But the fee games get worse from here. Number 8 is PNC Bank. Customers report crushing overdraft charges that pile up faster than they can fix a negative balance, sometimes triggering a second or third fee before the first one even finishes processing. PNC also got hit with a federal fine for flood insurance violations, failing to maintain required coverage on properties tied to its mortgage loans, which put homeowners at real financial risk during disasters. On top of that, it's fighting a class action lawsuit after a data breach exposed roughly 740,000 customer records, meaning your account details and your money were both mishandled under the same roof at the same time. When a bank can't protect your data or your balance, you have to ask what exactly you're paying monthly fees for. And speaking of trust being broken, this next one copied the industry's most infamous scandal, almost step for step. Number 7 is Fifth Third Bank. In 2020, the Consumer Financial Protection Bureau sued Fifth Third for opening checking, savings, and credit card accounts in customers' names without their permission, all to help employees hit aggressive internal sales quotas that were tied directly to bonuses and promotions. Some customers didn't even discover the accounts existed until they saw an unexplained charge on a statement or a mysterious hit to their credit score months later. Nearly 91% of its reviews on Consumer Affairs are 1-star, and complaints frequently mention slow fraud resolution, unresponsive support lines, and accounts that took months to properly close. When almost everyone who writes a review is furious, that's not bad luck. That's a pattern baked into how the bank incentivizes its own employees. Unauthorized accounts, it turns out, are more common in this industry than most people would ever guess. Number 6 is U.S. Bank. It paid over $37 million in penalties for opening checking, savings, and credit accounts using customer data without proper consent, echoing the exact same playbook we just covered with Fifth Third. During the pandemic, U.S. Bank also mishandled unemployment benefit payments processed through its prepaid card system, leaving tens of thousands of already struggling workers locked out of their own money for weeks at a time, right when they needed it most to pay rent and buy groceries. I remember watching similar systems get rushed into production without proper stress testing, and this is exactly the kind of failure that results. When people needed their bank the most, the bank's own infrastructure failed them. Now let's talk about a bank that specifically targets people who can least afford to be targeted. Number 5 is Credit One Bank. It markets itself directly to customers who are rebuilding damaged credit, positioning itself as a second chance, then buries them in hidden fees they never see coming. From processing charges to unclear billing cycles engineered to trigger late penalties, 97% of its Consumer Affairs reviews are 1-star, and it tops the list of most hated banks in 5 separate states, according to consumer complaint tracking data. Preying on financial vulnerability isn't a side effect here. It's the core strategy the entire product lineup is built around, from the interest rates to the fee schedule to the fine print nobody reads. If you think the smaller names are bad, wait until we get to the giants, because scale changes everything. Number 4 is Capital One. Over a 3-year period, it generated more fee-related complaints to the Consumer Financial Protection Bureau than any other financial company in America, 1,648 of them, more than banks twice its size and reach. Customers repeatedly report being charged late fees despite paying on the exact due date, simply because of narrow payment cutoff times buried deep in the fine print that most people never read until it's too late. Others describe getting hit with multiple overlapping fees for a single missed payment, stacking penalty on top of penalty. That's not an accident, that's engineering. And I've seen the spreadsheets that model exactly how much penalty revenue a policy like that is projected to generate before it ever launches. And this next one has a rating so bad it's almost historic in the world of consumer banking. Number 3 is Citibank. Around 98% of its consumer affairs reviews are 1 star, one of the most lopsided negative ratings in all of consumer banking today. Regulators previously sanctioned Citibank for deceptive student loan servicing, including improper late fees, misleading billing statements, and false claims about tax benefits that cost borrowers real money over years of ongoing repayment. Customers also report long hold times and repeated transfers between departments just to resolve basic account errors, sometimes spending hours on the phone without ever reaching a resolution. When nearly every customer walks away angry, something structural is broken, not just a handful of bad branches or a few rogue employees. Now we're entering the 2 banks so big, they genuinely think they're untouchable. Number 2 is Bank of America. In 2023 alone, regulators ordered it to pay over $250 million combined for 3 separate violations happening at the exact same time. It illegally double-charged overdraft fees on the very same transaction. It withheld credit card sign-up rewards that were promised in writing to customers, and it opened accounts without customer consent, again echoing the same pattern we've seen at multiple other banks on this list. It also holds the highest raw number of CFPB complaints of any bank in the entire country, over 128,000 logged complaints in the tracked period. Size doesn't excuse behavior like this. It amplifies the damage across millions of accounts simultaneously, turning a single bad policy into a nationwide problem overnight. And now the bank that even other bad banks get compared to when people want to describe the worst case scenario. Number 1 is Wells Fargo. This is the bank that lost its Better Business Bureau accreditation back in 2016 and never earned it back. 96% of its reviews are 1 star. Its Better Business Bureau customer score sits at a dismal 1.0, 8 out of 5, and it is rated the most hated bank in 10 different states across the country. The fake account scandal alone involved millions of unauthorized deposit and credit card accounts opened just to help employees hit impossible sales targets, and it triggered years of congressional hearings, executive resignations, and a complete overhaul of the bank's sales culture. Regulators are still ordering Wells Fargo to overhaul its risk management systems today, nearly a decade after the original scandal broke, which tells you how deep the DWI's function actually runs. 15 years in this industry, and Wells Fargo is still the one name that makes other bankers wince when it comes up in conversation. Now, take a breath, because it is not all bad news, and this is exactly why I wanted to make this video. Here are the 4 banks and credit unions actually worth switching to in 2026. Number 4 is Axos Bank. It's fully online, which means no branch overhead getting passed on to you in the form of hidden fees, no monthly maintenance charges eating into your balance, and no minimum balance requirements to stress about every month. Its hybrid savings and checking product pays up to around 4.21% APY, which is dramatically higher than what most legacy banks offer on comparable accounts sitting in a physical branch. It also offers expanded FDIC coverage up to $2.5 million through an insured deposit program, giving you genuine peace of mind well beyond the standard insurance limit most banks provide. If 4 sounds good, 3 is even smarter for everyday use. Number 3 is Ally Bank. Ally built its entire reputation on transparency, offering competitive rates across checking, savings, certificates of deposit, and money market accounts without the confusing tiered structures many banks use to quietly hide lower effective yields from their customers. Customers consistently praise its mobile app, its 24/7 live support availability, and its clear, upfront communication about rates and fees before you ever sign up. That's the exact opposite of the fine print games we just walked through with the first 9 banks on this list. Now here's the option most people overlook completely, and honestly, that's a mistake. Number 2 is Alliant Credit Union. As a not-for-profit, member-owned institution, Alliant pays interest on checking, something most traditional banks simply refuse to do for everyday customers, along with a savings annual percentage yield sitting around 3.1%. Members also get access to over 80,000 surcharge-free ATMs nationwide, plus monthly rebates on any ATM fees that do occasionally slip through the cracks. Joining is almost effortless, and Alliant even covers your $5 membership contribution for you, removing the last small barrier that keeps people from switching. And finally, the one that takes the crown this year. Number 1 is SoFi. Its checking and savings combo pays up to around 3.3% APY with 0 monthly fees and 0 minimum balance requirements, a combination that's almost impossible to find anywhere at a traditional legacy bank. Through its partner bank network, SoFi extends FDIC insurance up to roughly $3 million, spreading your deposits across multiple partner institutions for serious, layered protection. It also gives you fee-free access to a massive nationwide ATM network, and it integrates cleanly with loans and investing tools if you ever want to grow beyond a basic checking account into something bigger. After 15 years watching banks nickel and dime their customers at every possible turn, SoFi is the rare example of a bank actually built around the people using it, not quietly working against them behind the scenes. 9 banks to walk away from, and 4 that earned your trust in 2026. Like and subscribe for more.